Okay, good evening, everyone. We can start with the class. Let's start with the class MAC3761 costing. So today we're going to look at direct and absorption costing. Direct and absorption costing are the center for our costing. You will see that everything that we do, we have to have a bit of understanding of direct and absorption costing. It is consolidated in most of our costing topics. So understanding it will make the work easier. So let's look at direct and absorption costing. What is this? I think when we're doing our cost classifications, those are the areas that you should understand, so that even now when you do your direct costing, absorption costing, you now understand the costing terms. So most people I saw, they overlook that topic. They say it's just a simple straight topic. Sorry, but understanding it is very important because it's going to give you an understanding of the more. That's why you see, even if you open a textbook for CTA for whichever level, as long as it is costing, they will start with cost classifications, because this is where you should start to build your understanding of costing. What is a product cost, and what is involved in the cost of the product? It's very important even when you do big chapters in costing. Right, so let's look at first is direct costing. In other textbooks, you can see they can call it marginal. In other books, they can call it marginal costing. So you will see sometimes the question can requires you to calculate the profit using the marginal costing. So which means marginal costing is just like incremental costing. So when we are using the direct costing, it means we are using the incremental costing. Right? In the direct costing system, what we just need to understand is here, only variable costs incurred in the manufacturing of the product are going to be the cost of the product. So which means in our direct costing, when you are looking at your question, you should look at variables. And when you look at variables, you must also take note of manufacturing variables. We have manufacturing variables and non-manufacturing variables. But in direct costing, we take those into the cost of the product. The only difference is going to be when you do your inventory valuation. That's when you only use this part. That is the manufacturing cost of the product. But when you calculate your contribution, it means even those non-manufacturing costs, you are going to include them into the cost of the product. So it's very important to know the difference between manufacturing cost and other variable costs. So that's on direct costing. So when we do direct costing, it means we are only going to take variable manufacturing cost into the cost of the inventory. When we talk of inventory valuation, I think we'll talk about it down there. Let me just leave it for now. Right, so which means variable selling and distribution costs are added to arrive at total variable cost. So in your question, you should be able to identify non-manufacturing variables So which means your total variable cost is going to include non-manufacturing and manufacturing variables. That's another thing that we should always look at when we are doing our questions. It's very important to start by the manufacturing so that when you do your inventory valuation, then it's going to be easy. You will see when we do inventory valuation in a question, right? So now we have our contribution. So our contribution is going to be made up of sales variable cost. Do you see here in the variable cost, we are now including non-manufacturing variables. So that's variable cost. We are including non-manufacturing variables so as to arrive at contribution. So that's another area that you should look at when you are busy with your questions. Does the question requires me to use the direct costing or the absorption costing? Right, you will see the difference. I will try to point the difference between the direct costing and the absorption costing. There's someone, let me just admit them. Right, so in all fixed costs are going to be period cost, which means they are going to be expenses. They are going to be expenses. All fixed costs are going to be expenses when you are doing your direct costing. Let me just allow these other guys. They are late for class. Right, so all fixed costs are treated as period costs, which means they are going to be expenses. When we say expenses, it means they are not going to form part of the cost of the product. They are going to be expenses to arrive at the profit for the organization. Right, so let's look at the presentation that I want you guys to see. Right, so when we are using the variable cost of sales, right, if you use this term, variable cost of sales, then it means there we only need until here. Because you have said variable cost of sale. So which means we are looking at these manufacturing costs. Those are the cost of sale. So your wording here should match with how you are going to do here. So if you know that you cannot differentiate between, but it's very straightforward, you will now say less variable cost. Then you don't put this of sale. So if you say less variable cost here, then it means you are now going to include this non-manufacturing variable. So what you give, the heading that you give here should also tell the structure that you are going to do here. So if you say less variable cost of sale, then it means we are looking at this manufacturing cost. Those are the cost of sale. But if you say less variable cost, then you now include the non-manufacturing variables like distribution cost, variable selling cost. Then you will now arrive at the contribution. And the difference between absorption costing and direct costing is that in absorption costing, you will see that here in absorption costing, we are going to include fixed manufacturing overheads into the cost of the product. So which means we're going to have a line here of fixed manufacturing overheads. You are doing the absorption costing. So that's the only difference between the direct costing and the absorption costing. So when you are doing your direct costing, it means you look at all variables the variables are going to be used to calculate the what? The contribution. But when you are doing the absorption costing, you will see that here you will include fixed manufacturing overheads. And also these variable selling costs will not be part of the cost here. So that's the difference, but I will try to elaborate it on when we do absorption down there. Right, so here it means all fixed costs here, you are going to take them as period cost, which means they are going to be expensed to the company. So these are going to be expenses, all fixed costs, which means whether they are manufacturing costs or not, they are going to be expensed by the business. But if you check, when you will see when you are doing the absorption costing, you will see that here these fixed manufacturing overhead will be part of the cost of the product when you are doing the absorption. And if you check now, you will see here they only include here the variables and they exclude anything fixed. So which means in your variable costing, anything fixed is not going to be part of the cost here. Anything fixed, whether it's manufacturing or not, it's not going to be part of the cost. But when you are doing your absorption costing, you will see that this one will go up and this one will go down. Because in absorption costing, we only focus here on manufacturing cost, whether fixed or variable. So which means this variable selling and distribution cost will now go down under non-manufacturing cost. So that's when you are using the absorption costing. But for the direct costing, just know that here you are going to have variables. All variable costs are going to come here. Then here we have fixed costs. That's your direct costing. Then let's go to, we've already talked about contribution. Contribution is the amount of product sold less the variable cost. So that is going to be our contribution, which means our sales less contribution, less variable cost. Then it's going to give you contribution. Right, you will see that this contribution we will use in most of the chapters. So when a question requires you to calculate contribution, just know that you are going to focus on variable cost. If the question requires you to calculate the contribution of the product, then it means you are going to focus on variable cost, right? Let's look at the absorption costing now. So in the absorption costing, you look at here. Do you see the difference? In variable costing, we were ending here. Then in absorption costing, we added this line, the fixed manufacturing overhead. So that's the difference. So what it means is here, the cost in absorption costing will be more. There will be more cost here in absorption costing than the direct costing because of this line. The cost of the product will be more as compared to the direct costing system. Remember I said, even when you are using the direct costing system, you should understand the manufacturing cost of the product. These are the ones that we focus on when we do our inventory valuation. So which means it's very important to understand what is a manufacturing cost, what constitutes a manufacturing cost in a question, so that if the question requires you to calculate the manufacturing cost of the product, then you know what goes into the manufacturing cost of the product. So the only difference that I mentioned here is this line, the fixed manufacturing overhead. You will see here Okay, let's just go to, there is also valuation of inventory. Then they say opening and closing inventory are valued at full production. Hello, can you please mute yourself if you are busy with something?
Sorry, sir.
Right. I was here on valuation of inventory. Right. In valuation of inventory, when we are using the direct costing, when we value inventory, it means we are going to use the variable manufacturing cost. And when we are using the absorption costing, we are going to use all manufacturing costs. So when you are using them direct costing to value your inventory, it means you are going to use the variable manufacturing cost. But when you are using the absorption costing, it means you are going to use them all the manufacturing costs into the cost of the product. I think the question is a bit long question that we are going to do together. It has this, we have to mention this in that question. When we talk of valuation of inventory, mostly we value opening and closing inventory. So in your valuation of opening and closing inventory, it means it's now depend on whether you are using the variable or the absorption costing. So in that case, it means if it is the variable, then you're only going to take all the variable manufacturing costs into the cost of your closing inventory. Right, then there is also this under or over absorbed overhead. We only meet it when we are using the absorption costing. That's when we have over or under absorption. This comes on budget and actual. So which means the budgeted overheads and the actual overheads are the ones that are going to create an under or over absorption. If your budgeted overheads are more than the actual, then there is an over absorption there. If the budgeted is less than the actual, then there is an under absorption in that case. Here, I also want you guys to check properly to understand when we are doing our question. This part, I always see most people, they get confused with this part, under the under or over absorption. What to do, are you to add or to deduct? That's one area that I have seen people struggling with. Right, so let's look at the direct the absorption costing statement. Right, if you go to your absorption now, you can see here. I'm no longer going to say, we're now talking of manufacturing cost of sale. Here in the direct system, we were saying variable cost of sale. So here in the absorption costing now, it's going to be manufacturing cost of sale. And the only difference inside is going to be here. You will see that in our direct costing, we ended here. But here we are going to have a fixed manufacturing overhead that is going to be absorbed into the cost of the product. That's the only difference between the two. Here we are going to have fixed manufacturing overheads. But in the direct costing, we don't have this fixed manufacturing overhead. So when you are this format, I expect you guys to know them by head. Just to, even when I look at the question paper, let's say the question wants me to use the absorption costing. Before even looking at the figures, this I'll just write my structure. Like, then I'll because once you know the structure, then you know what you are looking at. For an example here, if you know you are going to use the absorption costing, then you know I need all this in the absorption costing. But if you don't know this format, the structure, then it's going to be a problem, because what are you going to build? Because you don't know what you are building. So it's very important to know what are the elements of the absorption costing and what are the elements of the direct costing, so that the moment you are reading a question, you know this goes to where, this goes to where. Because in the exam, there is no time to think. I always say this, but people think that I'm joking. If you are finding yourself thinking too much in the exam, then you are not prepared for that exam. In the exam, there is no time to think. It's just writing what you know. Because that time that is stipulated is for people who are writing what they know. It's not for people who are thinking, taking 10 minutes, thinking where to start. No, it's not for those people, the exam. So what I'm trying to say here is always know this when you are going to each and every topic for costing, whatever. Know all the format of each and every topic. I'm doing relevant costing. What is expected in relevant costing? Because if you don't know those things, then in the scenario, what are you going to take to your answer? Because in the first place, you don't know the structure of what you are going to answer. So each and every topic, if it is any of the costing topic, know the structure of that particular topic, so that the moment they requires you to do that question, then you know what am I taking from the scenario. That's one thing that I've realized, which makes us become very slow in the exam, because we take time even thinking about the format of the answer, instead of us just putting our format here, then look for figures from the scenario and put them on the format. Then we take too much time trying to struggle with the format itself. So it's very important to know each and every topic. If they ask you about limiting factors, you should know the structure of calculating a limiting factor. You should know it in your head, because if you don't know it, then there is nothing you are going to do. You are just going to be writing. I don't know what you will be writing. The first thing is to know the structure. Then you now look for figures to put in that structure. I don't think it's going to be very difficult, even though you are not going to take all the marks, but you will definitely get something. But the problem comes, we don't know the topics. All the costing topics, you should know. If they ask you to do this, the direct costing, what is the structure of a direct costing, then it's going to be easy now, because if you know your structure, you just know that at the top I'm going to say sales. Then I need direct material. So you will be looking for this in your, because already you have your structure. Where are the direct material? Where are the direct labor? Where are the variable? If you don't know that you are going to use this, then it's going to be a problem for you to build that question. So the format is very, very important for you to understand. Right. So the difference here, the other difference that I was trying to say is here. If you check in our direct costing, we don't come here and say less non-manufacturing cost. Here we say less fixed cost. So you can see here in the absorption costing, whether a cost is variable or fixed, as long as it is a non-manufacturing cost, it is going to be a period cost, which is going to be an expense. It's going to be an expense. As long as it is a non-manufacturing, it's going to be an expense. That is in the absorption costing. But if you look in the direct costing here we come and say less fixed cost. Do you see the difference? Which means we did not take any fixed cost in the calculation of our contribution. So all fixed costs will now come down when we are using the direct costing system. But when we are using the absorption costing, we come here and say less non-manufacturing cost, which means anything, whether variable or fixed, as long as it is not part of the manufacturing of the product, then it's not going to be accounted. So that's another reason. That's why I say that cost classification is very important in your MAC. Understand cost classification, because when you come to these higher chapters, it's going to help you. Because if here they say non-manufacturing cost, if you have not done your cost classification properly, then you will not be able to identify which one is a manufacturing and which one is a non-manufacturing. So you end up now mixing the figures. So that's basically the difference. So the difference between the absorption costing and the direct costing is only here. On the first part is here. Here we take only the variable under the direct costing. All variables are going to be part of the cost of the product. Then when we are using the absorption costing, if anything is a manufacturing, then it's going to be part. So that's the difference. So here we'll now say all fixed costs, which whether manufacturing, they are not going to be part of the cost of the product when we are under the direct costing system. Right. So that's basically how. Right. Let's look at this part. Impact of inventory levels on profit. The impact of inventory levels on profit. Right. When we are here on this part, I want you guys to understand this part. I will just give a small example before we go to the question, especially on these inventory levels. Right. When we have opening and closing inventory, you will see that even if we have the same figures in the question, and we are required to calculate the profit using the absorption and the direct costing using the same figures, but you are going to have a different profits. I think if you guys have done your 2601, you notice that as long as there is opening and closing inventory, you are provided with the same figures. But when they requires you to calculate the profit using the absorption and direct costing using those same figures, you are still going to get different profit figures. So why do we have those different profit figures? It's here. The profit under absorption costing differ from the profit under variable costing when we have closing and opening in inventory. The difference arises due to the difference of total fixed cost charged in absorption and variable costing. Right, I will illustrate by a small example that one. Right. So what it means, what they are saying there here, when they say the difference arises to due to the difference of total fixed cost charged in absorption costing, you will see that when you are doing your direct costing here, let me just say direct costing, then absorption. Right, you will see that when you do your inventory valuation, under the direct costing, you are going to use direct material, direct labor, and what else? Direct manufacturing overheads. You are going to use them to value your inventory. But when you use the absorption, you are going to have your direct labor material here. You are going to have your direct labor. You are going to have your direct manufacturing overheads. It's not direct, it's variable, sorry. Variable manufacturing overheads. Then you are also going to use your fixed manufacturing overhead. So what it means, when you do your inventory valuation under these two costing system, you will find that the inventory value under the direct costing is going to be less as compared to the absorption costing. Because in the absorption costing, you are going to include the fixed manufacturing overheads into the cost of your inventory. So what makes this profit different now is when you value your inventory. Remember, in our, we say sales less cost of sale, then less the variable cost, then we now less closing inventory. Right. So in this closing inventory now, this is what makes this profit different. Because under the direct costing system, you will see that the value of the closing inventory will be less here. So once you less a less figure for closing inventory, then it means your cost of sale will remain higher. So the profit under direct costing is going to be less than the one under absorption costing because of this inventory. Because when you do your absorption costing for closing inventory, you will see that you are going to take all these, which means the value of the closing inventory is going to be more. So if the value of the closing inventory is more here, if you take out more from the cost of sale, which means you are going to be left with a less cost of sale, which means the profit is going to be higher. So that's the difference. Because of this line, these fixed manufacturing overheads are now going to make these profit to be different based on absorption and variable costing. It's very important to understand this part, because at some point you will be required to do profit reconciliation. I think we did that in at this level. They don't require us to do that in the exam. We did that in our MAC3761, where they will require you to do a profit reconciliation. Because remember, we say absorption costing profit and direct costing profit will be different. So they want you to figure out what makes that difference, which means the fixed manufacturing overheads, which are here under the absorption costing, are the one that makes that difference. So that's basically why, if we are provided with the same figures, and when we are required to calculate the profit using the absorption and direct costing, the profit becomes different. It is because of this line. In your valuation of closing inventory, you have included fixed manufacturing overheads, whereas here you don't have fixed manufacturing overheads, you only have variables, which means this is going to be less. The cost of the closing inventory here is going to be less. Then here the cost of the closing inventory is going to be more. So that's basically why the profit figures are going to be different. But you will see when we do the question, they even explain it here. They say the difference arise because inventory in absorption costing include fixed manufacturing overheads, whereas the variable costing system does not include fixed manufacturing overhead. So that's what makes the difference between the inventory values in absorption costing and direct costing. Right? Oh, there is a question. Let's look at, unless if there's anyone with something that needs clarification before we look at the question. Before we look at the question, let's have anyone who needs a clarification. Okay, so let's look at the question. I always prefer the question. The question will explain more when you are doing the question. I think I took it from your that textbook for MAC example 5.5 in your text, right? They say here manufacturing information for the 2020 financial year relating to Sweeties Limited is given below. We are given sales. In our third level, you will see the question that I will post. They will never give us a bonus like this where you are provided with straight figures. It will be a scenario. I'm going to send a question that we are going to do together. It's an integrated question. Remember, in our previous class, I said I want us to do direct and absorption costing so that we can start to be able to practice integrated questions. But in our exam, here is for illustration purposes only. For third level exam, there will be no equation like this. It will be a long scenario where you have to pick the figures from the scenario. So for illustration, let's just look at what is here. So they give us the sales, they give us the production, they give us direct material, direct labor. So here it's straight. Variable manufacturing overhead, budgeted fixed manufacturing overheads, normal capacity, actual fixed manufacturing cost. Remember, this is where you will get your over and under. These are the actual. So you are going to compare these actual and your absorbed manufacturing overheads. Then you will see if it is an under or over. Then we have a closing inventory for 2010. So as long as we are going to have a closing inventory, then it means we are going to have different profit figures because of the valuation, the different valuation in the closing inventory. Right, then additional information says fixed manufacturing overheads are allocated on the basis. This is one of the most important part when you are doing your absorption costing. Fixed manufacturing overheads are allocated on the basis of the number of means produced, which means you are going to use your fixed manufacturing overheads rate is going to be determined by the number of means produced. So when we look at the number of means produced, we look at the budgeted. We don't look at the actual, we look at the budgeted. Because remember, fixed manufacturing overheads absorption, we base them on budgeted figures. We don't base them on actual figures because we assume that they are going to be made available before the end of the financial year. So which means we'll be using them throughout the financial year until we get the actual. So when you are doing your calculation for fixed manufacturing overheads, you look at the allocation basis. What is the allocation basis for fixed manufacturing overhead? Then here they say you are going to use the number of means produced. Then there is also this part is also very important. Inventory to be valued on the FIFO basis. Right, let me explain this before we do the answering of the question. We have FIFO and mostly we use FIFO and weighted average. So if the question says you are going to use first in, first out to value your inventory, what it means is in the value of your inventory, you are not going to include opening inventory when you are using the FIFO. Remember, it says first in, first out, which means the one for last year, which is the opening inventory, is not going to be part of the inventory valuation. That is when you are using the FIFO. If you are using the weighted average, then you are going to include all the inventory, opening and closing. So always look at the question. Do I have to use FIFO or weighted average? But for most of our questions, I realize they prefer to use the FIFO. So if it is the FIFO, then it means the only thing that you need to know here is you are not going to include opening inventory into the cost of the inventory valuation. So that's the only difference. But when you are using the weighted average, you are going to include it as part of the inventory valuation. So that's the difference between FIFO and weighted average. So you should also look at this part, inventory to be valued on the FIFO basis. Right, then what are we required to do? We are required to prepare the actual income statement for both the absorption and the variable. Let's start with the absorption. I think is the one that that need more. So let's start with the absorption costing. Right, so let's look at the absorption costing. Let's start with the absorption costing. As long as you understand what you are doing, these things are not difficult. They are not, I don't agree when people say, yes, make, yes, we give it that name because we don't give it time. That's the only problem. We don't give it time. We want to rush last minute. There's no, at your third level, these modules are preparing you for CTA. So if you do study them the way we used to do in first year, just to pass, I don't think you will survive. This module for third year, you need to understand them very well. Because remember, the questioning itself is preparing for CTA. Someone who has done this MAC3761, when I look at all the syllabus for CTA, I don't see anything new there. I just see maybe they just put it in another way, but it's most of the things you have done them. So which means if someone understood these modules at third level very well, then even the CTA is going to be very easy. Right, so let's look at the absorption costing. So which means we want to cost based on absorption costing. Right, in your absorption costing, remember I talk about the structure. We say you need your sales. These are things that you know. As long as you are doing your costing using absorption or variable, then you have to. So which means I'm going to say less cost of manufacture, direct labor, direct material, variable manufacturing cost, then fixed manufacturing cost. I think let's just end here. So which means these are some of the things that you should know. I'm doing the absorption costing, which means I need direct labor, direct material, variable manufacturing cost, fixed manufacturing cost. Then you go to your question to pick the figures. So if you know your structure, it's going to be easy. I don't think you will not be able to see what is direct material here. They even mention here the direct material is 1000 kg at 20 rand per kg. They will never trick you like they will give you a figure. Even if it is a long scenario, the figure will be there. So which means here we're going to have 1000 times 20 kg. So that is going to be our direct material. So it's going to be 1000 times 20 rand. That's our direct material. Let's look for something else. I put something which is not supposed to be there. Let me check. I put the direct material. It's supposed to be direct. Okay. So the direct labor is 1050. 1050. So it's 1000 at, let me just do this. So it's going to be 1000 times 50. That's your direct labor. Then our direct material is going to be 1000 times 20. Then let's look at the variable manufacturing cost. Variable manufacturing overheads, 2000 machine hours at 30 per hour. So which means we are going to take 2000 machine hours. Then it's going to be 2000 times 30. Right, that's there. Let's have our figures. Let's assist each other to do the calculation. The first one is going to be how much?
50,000.
Sorry?
50,000.
50,000. Then this one is going to be how much? It's going to be
20,000.
20,000. Then this one is going to be
60,000.
60,000. Huh?
Yes, 60,000.
Right. Then let's calculate our fixed manufacturing cost. Right. So when we calculate our fixed manufacturing cost, we come here. We should be guided by this statement. They say fixed manufacturing overheads are allocated on the basis of the number of means produced. Inventory, okay, so which means we're going to do fixed manufacturing overheads on the number of means produced. So which means you are going to calculate your fixed overhead rate using the normal capacity, because this is the budget. This is their budget. Remember, we say we calculate, we allocate fixed manufacturing overheads using the budget. So which means this is what they were expecting. So it's the one that you are going to use to calculate your fixed manufacturing overhead absorption rate. So it's going to be 9,000 into the budgeted fixed manufacturing overheads. So which means it's going to be 90,000 over 900,000 times the number of means that were produced. The number of means produced is 1 million. So these are going to be your fixed manufacturing overhead. It's going to be 90,000 over 900,000 times 1 million based on this statement. This is what is going to guide you in your how do you allocate fixed manufacturing overhead? Here they say fixed manufacturing overheads are allocated on the basis of the number of means produced. So which means when you allocate on the number of means produced, you are not going to wait to have your overhead absorption rate. So your overhead absorption rate is going to be your fixed cost over budgeted manufacturing units. That is going to be your overhead overhead recovery rate. So which means it's going to be fixed cost over budgeted manufacturing over budgeted units. So which means our budgeted units is this normal capacity, because this one is the actual, it means that we produce. So our normal capacity is now going to be the budgeted. Right, so we do go to our question and now say the number of means that we produce is 1 million. So which means we just go and say, so our fixed manufacturing overheads, it's not cost, overheads, is now going to be fixed cost, budgeted fixed cost over budgeted manufacturing. It's 900,000 times the number of means that were produced is going to be 1 million. So this is the fixed manufacturing overheads that you are going to absorb. How much are we going to absorb into the product? $100,000, am I right? Are we there? Are we there?
Yes.
We're going to get 100,000. Do you see what happened?
Yes.
This is important in your MAC to be able to calculate this. Understand how do I calculate the fixed, because we are going to absorb them. This figure is not going to be a straight figure. We need to calculate. So you need to know how do we absorb fixed manufacturing overheads into the cost of the product. So if you come to the question, you will see that here the question says always be guided when you are doing the moment I am doing absorption costing. If I don't find this line, then I know I'm not yet getting all the information. I must find this line when I'm doing absorption costing. Fixed manufacturing overheads are allocated how? Because remember, in your absorption costing, you are going to have fixed manufacturing overhead. So you need to know the allocation basis. They are going to be allocated on the basis of the number of means produced. So which means you are going to allocate based on manufacturing units, manufactured units here. Because we are talking of means produced. In some of the questions, they can tell you you are going to allocate based on labor hours. So if they say you are going to allocate fixed manufacturing based on machine hours, on labor hours, then it's going to be, so your overhead absorption rate is going to be the fixed cost over, if it is machine hour, then you say machine hour times actual machine hours. So that is going to be your overheads that is going to be absorbed. So the question will tell you, if they say it's labor hours, which means your absorption rate is going to be fixed cost over labor hours. Then you multiply by the actual hours that were worked. Then you have already have your absorbed cost into the cost of the product. So that's basically, so this line, if you don't find this line, or you did not attend to this line, then you know everything that you were doing, most of the things are not going to be right. The moment I am doing a question, I should look at how do I allocate fixed manufacturing overheads into the cost of the product. Then you know the allocation base, because it's not always the same. It differs based on the question. Right. So in our case, we've allocated based on the number of means produced. So which means you are going to have the number, the allocation basis is going to be fixed cost. In our case, we say 90,000 budgeted. Remember, when you are calculating the overhead absorption rate, you use budgeted figures. You don't use actual figures to calculate the overhead absorption rate. You use budgeted figures. So these are the budgeted overheads over budgeted manufacturing units. Then you multiply by the actual units. So you are going to have your fixed manufacturing overheads, which are going to be absorbed into the cost of the product. So that's that's how we do this part. It's very important in your costing to understand this part, right? When we have our fixed manufacturing overheads, so what did we say is the sales? We never talk of the sales. Where are the sales? Our sales is 980 times 40 cents. So it's going to be, our sales is going to be always show if this calculation inside the bracket, but if you feel the calculation might be long, you can do them separately. Then here you just indicate. But if they are short like this one, you just put them inside your, so this is 980,000 means times 40 cents. How much are we going to have there?
392,000.
392,000. So it's going to be 300. Right, that's yeah. Then what do we want? We need the cost of production. All right, here I think the best is let's have a figure here so that we can less closing inventory. How much are we going to have if we add all these 50 plus this one plus it becomes 150, 70. How much are we going to have there?
I'm getting 230,000.
So we're going to have 230,000. Then in this 230,000, you now less closing inventory. That you go to your question, what is the value of closing inventory? Closing inventory is 20,000 units. 20,000 units is the value of the closing inventory. Right, so which means what do you do? I will show you this way. How many means were produced? They produced 1 million means, right? So what you need here is the cost per mint. It's the cost per mint. That's what you need here. So you need to calculate the cost. Is it 1 million or this one is 1 million? The one the net, yeah, it's 1 million. Okay, so what you, yes, when you are calculating your value of closing inventory, there are so many ways of calculating it. Let me show you the easier way to calculate the value of closing inventory. So what you want here is the cost per mint here. You need the cost per mint. So which means these are the mints which were produced. So you divide by the cost of production to get the cost per mint. Then you multiply by the number of the closing inventory. So which means in our case, we are going to divide 1 million by the cost of production. Then we multiply by the number of the closing inventory, which is 20,000 here. So which means here you come here and do it like this. Right, it's going to be your cost per mint. It's not gonna be, it's going to be, the cost per mint is going to be, there were 1 million mints that were produced, sorry, so it's going to be 230,000 over 1 million times 20,000. Do you see what I did here? Here you are calculating the cost per mint. When you are using the absorption costing, it means you are going to use all these into the calculation of your closing inventory. Remember what we were talking about before. So this is the 230. This is the cost of manufacturing. So you need to look at now what is the cost per unit. So you divide by 1 million mints that were produced, then you now value your inventory. How much are we going to have as our inventory value there?
4,600.
So it's going to be 4,600. So when we have this 4,600, we less it from 230 now to get this cost of manufacturing. So which means we are going to have 230,000 minus 4,600. It's going to be how much? 225,400, am I right?
Yeah.
So you are going to less this. When we less this, where do we go after this? We now have our sales and our cost of manufacturing. So where do we go? The structure. Because if you don't know the structure, you will never win. So which means we need our gross profit, am I right? Our gross profit. So our gross profit is going to be made up of here 392 minus 225. How much are we going to have? Is 392 minus
166,600.
Sorry?
166,600.
166,600. That's our gross profit. Remember, we are using the absorption costing. We should look at here. What are the overheads that were absorbed into the product? It's 100,000. That's the absorbed. Then what are the actual? So which means you are going to compare your actual and your absorbed. Our actual is 93,000. You will see this one. So that's the actual. So you're now going to compare. We have 100 and the actual is 93. So what is it going to be? Is it going to be an over or an under absorption? Because it's going to be 100,000 minus 93,000. What are we going to call this one? Is it an over?
under absorption.
This is the actual. No, this is the budgeted, and this is the actual. Am I right? Who is actual here? 100 is the budgeted, ne?
Yes, 100 is budgeted and 93 is actual.
So is it an over or an under?
It's an under absorbed.
You guys, is it under here? We absorb more than actually. It's an over absorb.
Yeah, it's over absorbed.
Yeah, we absorb more. So it's going to be, how much is it going to be? It's going to be 7,000. So we say it's over absorption. It's over recovery. You can even call it over recovery. Right. So if it is an over recovery here of 7,000, what are we going to do with this over recovery? Are we going to add it or subtract it? I want you guys to understand also this part. Are we going to subtract it or to add it? Anyone who still remember from your 2601? What are we going to do with this 7,000?
I think we've add it.
We have to add it.
Yeah, to our profit.
Can you explain why so that others can hear? Why do we have to add it?
Yeah, because we over absorbed more. We absorbed more than we paid for.
So it's going to be.
So it's going to fortunately it's going to be an advantage to us because we paid less and we absorbed more.
Okay, right. This is the actual, right? What he's saying is correct. But let me elaborate on what he's saying. This is the actual, and this is the budgeted. Do you see what happened here? What it means here is, if you use a higher figure here, the higher figure in absorption is going to increase the cost of manufacture. So once it increases the cost of manufacturing, then it means it's going to reduce your profit. Because if the cost of manufacturing is increased, then it's going to reduce your profit. If your profit is reduced now because of this over absorption, it means to correct that, you reverse now. It was reduced here, so which means you are now going to add it back. So vice versa, if it is an under. If it is an under, it means you absorbed less. So which means your profit figure is very high because of the less absorption that you did. So when you do your over or under here, under absorption, then it means you are going to subtract that figure because the profit figure is too high. Because if you under absorb here, it means you are going to have less manufacturing costs and your profit figure is going to be high. So in that case, it means you need to take out that profit figure from the gross profit that you get. So that's under and over absorption. This one is very important in your this part. Let me just mention this one, and also know this also, the valuation of closing inventory, and also this one. They are very important, especially when you are using your absorption costing. Know how to absorb fixed manufacturing overheads, know how to evaluate closing inventory, know how to treat over and under recovery. Then if you are done with those, I think in your absorption costing, there's nothing else. Here is a matter of looking who is direct labor, who is direct material, who is variable manufacturing cost in the scenario. And another thing that I've seen in the questions, always look at the question. The question, does it say calculate the budgeted income statement or the actual? Some people, they get lost totally because they use the wrong statement. They are calculating the budgeted, but the question requires you to do the actual. You will see the question I'm going to post. I think it has all those. We need to be at third level, read the question properly, because we have too much information at third level. So you should be able to classify your information into the right category. Right, so now we have our over recovery. So we are going to edit. How much are we going to have as our adjusted?
173,600.
Adjusted gross profit. One what?
173,600.
So this is going to be our adjusted gross profit, right? When we have our adjusted gross profit, remember we're doing the absorption costing. So which means what we took here, all what is here is manufacturing. Right? That's there. So which means everything that is here is manufacturing. Remember, we say all non-manufacturing costs are going to be period cost. So which means the next line that we need is those non-manufacturing costs to arrive at profit for the year. So when you are using the absorption costing, this line you can call non-manufacturing cost, because everything that is not manufacturing, it's not like the direct costing where we can take variables, even though they are not manufacturing. Here we only focus on manufacturing costs into the cost of the product. So all non-manufacturing costs are now going to be expenses. Right, so we go to our question and look for the non-manufacturing cost. Right, who are these? The non-manufacturing costs, which means we can even look at fixed selling cost. It's not a manufacturing. Variable selling cost. It's not a manufacturing. Who else is non-manufacturing here? I think these are the only two non-manufacturing. So we're going to have fixed selling cost and variable selling cost. So we take those two. So we have fixed selling cost and variable So our fixed selling cost, they say, is 25,000. So let's look at the variable. The variable is going to be 5 cents per mint. These are selling costs. This is another area that I see people again mixing figures. They say 5 cents per mint, and these are variable selling costs. So if you are calculating variable selling costs, it means here, you are not going to use the mint produced. You are now going to use the mints that were sold, because we're calculating variable selling cost. So that's another area that you can mix things there. So we're going to say multiply by 980,000. So that's there. So we're going to put it this way. We're going to say 5 cents is 0.05 times 980,000. Am I correct on my decimal here? Is it correct? 5 cents. Yeah. So how much are we going to have as the final answer?
49,000.
49,000. That is going to be our right. Then the total for these two is going to give us how much? It's going to give us 4 here,
4,000.
74,000. So the next thing that we need is profit for the year. So what is going to be our profit? We subtract 74 from 173,600. Sorry? What is the profit? Was she saying something or she's this some 173,600 minus 74,000. 99,600 is going to be our profit for the year. Using the absorption costing. You will see now when we do the direct costing, the profit figures are going to be different. The profit figures are going to be different. They are going to be different because of here, the valuation of closing inventory. If you check, when we will be valuing our direct costing closing inventory, we are not going to use, this line is not going to be there. So which means there will be a less figure here. It will not be more than 230, it will be less than 230. So which means the value of closing inventory here is going to be different from the one that we have here. So that's the reason why we have different profit figures when we use these two costing systems. Right, so that's the profit using absorption costing. Right, I don't know if there is anyone with a question before we do the direct costing. Any question on the absorption costing? You need to practice. Give yourself time to practice, so that you get used to the principles. Yeah, I prefer you guys to know this structure. If it is absorption costing, know the structure of the absorption costing statement. Full stop. If you know it, I don't see you struggling to get these figures. Why should you struggle to get direct material, direct labor in a scenario? So the most important thing is this structure going downwards. After I have fixed manufacturing overheads, what do I do next? Which means I will have closing inventory. After closing inventory, I will have gross profit. After gross profit, I will check the under or over recovery. Then I will have my gross profit. Then from there, I will now have non-manufacturing. If you know this structure, it means even in the exam, it's not supposed to be much difficult. I know the exam pressure, but if you are well prepared, that pressure will be less. But if you are not, then you will be touching everywhere. Especially for these third level modules, these ones, for those who just started them, these ones are very, very tricky. So we need to take them seriously from the beginning. Don't say we still have time. That thing of saying the time is still there and people will not even be attending class, I'll watch the recording now. That is the problem, and people will start to have pressure last minute. That last minute pressure, you don't learn much. You are just trying to summarize things. Make FAC. You cannot pass them by just summarizing last minute. You need to understand them so that when you do the application, then you do the right thing. Right. So is there anyone who has a question before we do the direct costing? I want us to see the difference now. Any question on our calculation? I want you guys to understand this thing. This is what we are going to do throughout. So understand these things. Any question on any one of these, especially 1, 2, 3? Is there anyone with a question? Are we fine? So we can go and do the direct costing. Right, so let's do the direct costing system. So we have done, I think if I was having I can even change this and make it let me see if I can I have to remove this. The cells will be the same. I have to remove this. I also have to remove this. Let me just remove everything here. Right, so which means now we are doing the direct costing. We're now doing the direct costing. So the direct costing, the sales will be the same. And here we are not going to add anything here. Remember, we're dealing with the direct costing. So here we can say less. What do we say? Variable cost or less cost of sale?
Cost of sales.
You are free to say cost of sale or variable cost, but what I want you to understand is what makes up the cost of sale. So once we talk of the cost of sale, then it means we are now going to add this. The direct labor is still the same. The direct material is still the same. The variable manufacturing cost is still the same, like the absorption. The only difference which was here was the fixed manufacturing. So which means here we can now add, what are we going to get here? We get 70 plus 60, 130,
Yes.
right? Then you now less your, remember we say cost of sale. So which means we now need to less our closing inventory. Right, in our closing inventory, the same way we did, the only difference now you can see here we have 130 instead of 230 for absorption costing. So which means we are still going to say 130,000, which is the cost of manufacturing, over the number of means that were produced. Is how much? It's 1 million, times the closing inventory is still the same, the 20,000. How much are we going to have there on closing inventory?
Sorry, boss, can I ask you something?
It's 130.
Hey, boss, can I ask something?
Yes.
Are we not supposed to include the variable selling cost there?
Huh?
Are we not supposed to include the variable selling cost?
The variable cost of sale.
The selling cost.
Remember, your heading. Yeah. Remember, there is a difference between variable cost and variable cost of sale. There's a difference there. If you put your heading as cost of sale, variable selling costs are not cost of sale. Am I right? So your heading here will tell you what to do. If you say less variable costs, it means you are going to include all your variable in this line. And if you say less cost of sale, you need to calculate the cost of sale first. The cost of sale is this: direct material, direct labor, variable manufacturing cost, and we less closing inventory to get the cost of sale. Those variables selling costs are not cost of sale, they are selling cost. I don't know if you get if you guys can try to understand what I'm trying to say. Are we
Yeah,
together?
understood.
So I always look at I always prefer, if you know you will be confused on the way with this cost of sale, just put the heading, because this heading is going to tell you your structure here. If you say less variable cost, then you end there. It means you are not talking of variable cost of sale. You are only talking of all the variables, whether manufacturing cost or not. Then you are going to include them in your variables. But once you say cost of sale, it means you are looking at the cost of sale. You will see that variable manufacturing cost that variable selling cost, we will only take it to arrive at contribution, which means after we have our cost of sale, then we'll have our profit before variable selling cost. Then we subtract those variable selling costs. Then we can now have our contribution. Remember, non-manufacturing costs are only used to calculate contribution, but they are not cost of sale. We only use them to calculate the contribution. Right, so what is going to be this figure? It's going to be how much, this one?
2,600.
Sorry?
2,600.
So it's going to be 2,600. What are we doing? It's minus here, né? Right, so what is going to be our cost of sale here? We subtract from 130, we subtract minus 2,600. How much do we have there? I have here 127,400. Then from that 127,400, we now subtract it from the sales. So I'm going to say 392 minus 127,400. 264, né?
600.
600. Right, then we now less that variable cost you were talking about. So we are now going to take this variable selling cost. We're now going to check this variable selling cost. We calculate it as what again? But we can calculate it again. It's 5 cents per mint. It's going to be 5 cents times 980,000. So we're now going to less the variable selling cost. There's a difference between cost of sale and selling cost. There's a much difference there. So this one is going to be 980,000 times 5 cents. We say it's what? We say it's 49,000, am I right? We did it before. I'm now guessing. How much is it exactly? It's
49,000.
which is going to be 49,000. So we less this one. Then we're going to have here. We don't say gross profit now. When we are using we are now going to say contribution. So what is going to be our contribution is 264,600 minus 49,000. So our contribution is going to be 215,600. Right, when we have our contribution, we now go and do, remember here we included all variables. So here I can say, here we have all variables until here. So which means when you come here now, since you use all the variables, you're just going to say less our contribution, less fixed cost. Less fixed cost. So you go to the question again and look at all the fixed costs. There is 25,000 and this one. These are the fixed costs that we have. The actual fixed manufacturing cost and the fixed selling cost, which is 93 and 25. So we have fixed cost of selling. So it's going to be actual manufacturing cost. Which is 93,000. And you have fixed selling cost. Which is 25,000. Let's check if we have any other figure there. That is going to constitute fixed cost. Do we have any figure, any other figure? There's nothing here. So which means we are done there with the fixed cost. Then we can just come and calculate the total for fixed cost, which is 8 here, 11 here, 118,000. Then we have our profit for the year. Let's check and see. What is going to be our profit for the year? It's 215,600 minus is 215,600 minus 118,000. How much do we have as our profit? It's going to be 97,000.
600.
So that is the profit under the direct costing. So do we see that the profit figures are different here? The one for absorption is 99,600. The one for direct costing is 97,600. What might be the cause of the difference? Because of so it's going to be because of the fixed cost into these fixed costs that are in. Do you see something here? We have under the direct costing, we have 2,600 is the value of closing inventory. And under the absorption costing, we're having 4,600 here. So you see, under the absorption costing, the value of closing inventory is more under the absorption costing. So which means if the value of closing inventory is more here, it's now going to reduce your cost of sale. Then it means you are going to have a higher profit. But if the value of the closing inventory figure is lower here, it means your cost of sale is going to be more. Then if the cost of sale is more, then it also means your profit figure is going to be less. So the difference is here. Under the absorption costing, you could see that we had 4,600 here as our value of closing inventory. So the more the closing inventory, then the less here of the cost of sale. So that cost of sale is, if it is less, then it's going to have more profit. So that's why the profit figure differ here. And if you check, the profit figure must be different with these two. Let's check. Let's use, let me just come here and say, if I am correct, let's say, the other one is, let me just see if I am correct here, 99,600 and here 97,600. So if you subtract 97,600 here, you are going to have 0, 0, 0, 2,000. If you subtract 4,600 minus 2,600, you are going to have that 2,000, you see. So that's the difference in profit. It is because of this. In absorption costing, you had to include fixed manufacturing overhead into the value of the closing inventory. So the value of the closing inventory is more than the variable direct costing, because here you did not include the fixed cost. So the difference is only going to, the difference in profit is only going to be because of this part, the valuation of your closing inventory. So which means under absorption costing, you are going to have more value of the closing inventory than direct costing. So that's where this profit difference is going to be created. So that's basically what you need to understand when you are doing your, so which means here, this is where the difference in profit is on the valuation of the closing inventory. Right, I don't know if there's a question, if there's anyone with a question, anyone with a question. Any questions so far? Are we there? Are you guys there? Are we there? Is there anyone with a question before we close the class? Any question before we close the class?
Yeah, we are there, but we don't have a question.
Okay, so if there's no question, I'll ask you guys to rewind this recording. I'll send the recording after the class so that you can also be able to see what is happening there. Then I will send that question for integrated question. I think we should start to prepare ourselves for integrated questions. I'll send the integrated question that we'll be doing next week. Right, so if there's no one with a question, then I will close the class for today.
Thank you.